Free cash flow is the amount of cash that a company has left after paying all its cash operational expenses and capital expenditures. In other words, the company can freely use this cash to reinvest in the business, buy other assets, or to distribute to the owners. It is perhaps the purest definition of cash and a very valuable financial metric. And the formula for FCF is very simple. You start with the cash from operations, you reduce the capital expenditures, and you get the free cash flow. We can calculate free cash flow by starting from multiple points, but we will all end up at the same destination. So for example, you could start with net income or EBIT, which is earnings before interest or taxes, or revenue. So in this video, we will start with revenue minus all expenses, which gives us the accounting definition of net income. And if we take one particular path to the right, we will see that if we add interest and taxes, which are cash expenses, to the net income, we get EBIT. In addition, when we add depreciation and amortization, which you will recall are non-cash expenses, we get EBITDA, which is earnings before interest, taxes, and depreciation. So that's how you can go from net income to EBITDA. Now, in terms of calculating the free cash flow, we'll take a slightly different path. If we look down and we take net income and add the depreciation and amortization because they are non-cash, and then we either add the decrease in working capital or subtract the increase in working capital. And we do it because when your working capital goes down, that means there is a decrease, it releases cash. You're able to run your operations to the same level with using less working capital. On the other hand, if you are increasing the working capital, you are consuming more cash, and that's why it's a minus sign rather than a plus sign. And typically, as you know, working capital is accounted for by accounts payable or accounts receivables or inventory. Then we add any unearned revenue, which might be advance payments made by our customers, minus capital expenditures, and that gives us the free cash flow. So you will see all the way from left to the right end of this green arrow at the bottom, that's your operating cash flow. Minus capital expenditure gives you free cash flow. Let's go through an example to see how to calculate free cash flow. Let's assume for a moment that the net income is $2 million and the interest and taxes are another $500,000. Plus the depreciation and amortization, which are non-cash expenses, are $750,000. So the EBITDA, which is earnings before interest, taxes, depreciation, and amortization, is $3.25 million. Now, if we take the path which is going downwards and use similar data, we see that net income plus depreciation and amortization are $2.75 million. Let's also assume that we have $150,000 of plus working capital, which could have come about by a decrease in working capital requirements. For example, maybe lower inventory or lower accounts payable. Plus unearned revenue of $25,000, which could, as an example, be advance payments made by customers, minus capital expenditures of, let's say, $100,000. When we add all of these up, we get the free cash flow of $2.825 million. So this is the way you can calculate free cash flow starting from revenue or net income. At the bottom, you can see the green arrow, which shows the operating cash flow of $2.925 million, which is calculated by adding the numbers that are shown above the green arrow. So in this case, we can see that depending on the context, if we look at just the accounting entry of net income, it's $2 million. The EBITDA is $3.25 million. And the true free cash flow that is available for this to this company for either distribution to its owners or to reinvest in the company itself is $2.825 million.